Hello, welcome to today's webcast. Thanks for tuning in. I'm Eric Mancini, Partner Director of Investment Research with Trapegan. And today we're going to look at the recent market pullback and some uncertainty around the new administration's policies that have been one factor in the correction that we've seen so far in the markets. So, as an overview, first we're going to look at the backdrop of where we started, which is where the stock market was valued coming into 2025 and how it was constituted amongst stocks and sectors. Then we'll get into how Trapegan is viewing the major goals or policies of the new Trump administration, the uncertainty that certainly is around many of those policies, and then our look ahead into the back half of 2025 and into early 2026. So, the first thing to understand is where we were coming from, as we entered 2025. So this is a chart. Many clients have seen this. We've been using this for a while now, quite a while. And this is showing the S&P 500 in terms of valuations, average valuations. And coming into 2025, we were quite expensive. So we were only at this level at about 21 times earnings on the index level. Two other times in history. One was in late 21, early 22, which is when the bear market started with higher inflation and higher rates. And the other was the tech bubble. And again, this doesn't need to, precede a large downturn or correction, anything, but it does, indicate over the long term that maybe future returns of stocks will be lower than they were prior. If you have expensive stocks, that's common sense. And if you have cheap stocks, obviously, then chances are you would have higher returns. We came into 2025 with high valuations, about 22 times. And after the recent correction that we're going through as we speak, we're down to about 20 times, which is better. It's certainly less expensive, but still not cheap. And again, this is heavily weighted to the top 10 or so stocks, which are mostly tech stocks. And those are the stocks that are down the most this year. If you go and look at the other 490 stocks, a lot of those are actually up so far in 2025. And some of our strategies in publicly traded stocks are still up or near break even on the year. So we were coming in expensive, and then we were also coming in very concentrated. So this is on the left, looking at the different sectors within the S&P 500. We were about 41% technology, which obviously is a very large weight to that one sector. Then we had 13%, 14% financials, 10% healthcare, 8% industrials. But by far, obviously, technology was an outsized weight. And whatever technology did would have a huge impact on what the index has done. And if you look at the right, those are the stock holdings. So as we came into 25, Apple alone was 7.6% of the entire S&P index. NVIDIA was 6.6, Microsoft 6. And, as you can see, not just we were overweight technology, but we're really overweight mega cap or the Mag 7 type of technology names. And those are the names that are going down the most this year. We'll have a chart on that on the next slide. But for now, right now, as we're recording this, we're down about almost exactly 10% on the S&P 500 from the exact top we had just last month. So this happened pretty quick, and that's the way most corrections and pullbacks tend to happen. But this is not at all unusual. These type of pullbacks can happen for any reason. And in fact, we get a 5% pullback 3 times per year. We get a 10% pullback once per year, regardless. Even if there's nothing out of the ordinary happening, we tend to get a 10% pullback just randomly once per year. And then as you get higher and higher, it becomes more out of the norm. Where if you start to get a 15 or 20% pullback, that probably means something significant is happening. But as we sit at least now, it happens once a year, maybe even 2 times a year, what we're going through at this point. And it's important to note that's the S&P 500, where our client portfolios sit as of today, anywhere from positive 1% for the more conservative clients to maybe down 2 or 3 for the most aggressive. So much less than the S&P 500 because we took an active stance against being overweight those huge tech companies. And this is a chart showing different trends in different areas of the market so far in 2025, which is showing just that. So the S&P is down about 5-6% as we record this as of today, but the tech sector, down 10 or 11. And then if you just isolate those mega cap tech stocks, those are down close to 15-16%. So those are having a very outsized impact. Where if you were invested well diversified, which we are for our clients in defensive sectors, consumer staples, healthcare, utilities, those are all up on the year. They're defensive, certainly, but we like utilities for several reasons, one of which they are defensive, they have nice income, but it was also one of our AI plays. Consumer staples, healthcare, we have a good amount in. Foreign developed for the first time in a long time is an outperformer. We don't have any meaningful allocation to that, but we're getting it into defensive sectors within US. So that's where we came from. We were very concentrated. So regardless of, really what's going on with Trump policies or anything else, we were sort of set up where if anything that happened that wasn't really perfect, just a little spark we needed to get valuations more reasonable, to get some of the froth out of the market, and that's what we've had. Now that spark in this case was a lot of uncertainty around the new administration policies. So what Trump-Aiken did was really isolate all the individual policies that are the main pushes for the administration on the left, what we feel are the positive impacted assets, the negative impacted assets, and really quite important is, has that been largely resolved or not? So as we go down the list, the ones at the top are less important, I guess you would say. You would have, maximize domestic energy production, easier for natural gas exports, things like that. And that's obviously a help to pipelines, drillers, natural gas exporters. We do have natural gas exporters and pipelines in the portfolio. They're actually some of the best performing assets over the past 5 years, even far surpassing any other asset. We think those continue to do well. There's really few assets that are negatively impacted by that. Even though it's largely not resolved, the market is not particularly worried about that aspect. The less regulation push, more open to corporate M&A, that would help financials, private equity, IPOs, things of that nature. We do have exposure there as well. There'd be few assets negatively impacted by that. That is not fully resolved, but largely we know where we're going. Less regulation, so that's generally a positive. Very friendly to crypto and Bitcoin. That's very straightforward. It's positive for Bitcoin. A strategic stockpile has now been established, a strategic Bitcoin reserve for the US government, where they might actually acquire more over time. Obviously, that would help Bitcoin. No impact on other assets. That's largely been resolved. Now, the bottom four is where most of the angst and the volatility are coming from. So if we go by one, geopolitics, the Russia-Ukraine, possible ceasefire or not, NATO relations, all this type of stuff obviously can have impacts to some degree to all different types of assets. We just have to wait and see. There's no specific time horizon here. Obviously we're trying to get a ceasefire. The new administration is trying to work with Ukraine and Russia on getting a ceasefire. We'll see if they're successful, and then an ultimate cessation of the war. We'll see. That has certainly not been resolved. That's causing some angst. The Doge cuts certainly causing volatility and angst, possibly especially amongst government workers or private workers that are funded largely by government contracts. That would have few directly positive impacts in the short term. Obviously, unemployment could increase to an unknown degree. And that's, again, it's not resolved. We don't know how widespread these cuts will be. So that is unresolved. The biggest would be the tax cut bill, the extension of the 2017 tax cuts. Everybody pretty much expects this to be extended. We just don't know any details yet. So this, although seemingly on a pretty accelerated pathway, I think they're looking for Memorial Day or early summer type of codifying this into law. That would go a long way. Once we know the details, companies, corporations, individuals could start planning for 2026 taxes and forward once we get that. But as of now, it is not resolved. Very few details on that. The biggest one by far in the headlines and impacting the markets, in our opinion, is the tariffs and trade policy. We see headlines every day. of different tariff levels to different countries, and it's changing rapidly. So here, there is a theoretical timeline whereby April 2nd, seemingly the US will announce what the reciprocal tariffs will be. We'll see if that does happen. Then hopefully by the end of April, beginning of May, we'll have a lot of resolution on that, regardless of what the details are. If companies know what the tariff policy is, the trade policy is, and it becomes a much more stable environment, they can plan around that at least, and then we could go move forward. And if you combine all these things together, this is a chart we made where it's basically plotting over time. Time is progressing on the bottom, the uncertainty level as you go up. Right now, we believe we're in a period of max uncertainty. The markets hate uncertainty. CEOs hate uncertainty. We don't like uncertainty. So, we think right now, and for the next 2-3 months, we're probably in a max uncertainty period. But as time goes on, that will change. So hopefully by April or May, we'll have a much better idea on tariff levels and what that means for the economy, trade policy. CEOs can then plan and hopefully increases their confidence and investor confidence. Then sometime in the summer, most likely, we'll get the tax bill codified, or basically most of the details will be known by then. That will take out a lot of uncertainty as corporations, individuals, investors will know how to plan for 2026 taxes going forward. And then lastly, geopolitics, there's no specific time horizon on, but just as time goes on, hopefully within the next year or so, we get a much better idea of what's going on with Ukraine, Russia, and other hotspots. And as you can see, the way we're looking at this, if you want to sum this up in terms of uncertainty and market volatility, is, between now and say the end of May, continued volatility. This correction could last. It could go down further. It's tough to say in the short term. We would not be surprised with that outcome as headlines still continue to come out. But as time goes on, as we get especially towards the fall of this year and the beginning of 26, we think will be a much more certain regime, much more certain time frame. The market should like that a lot, and we'd be looking for a more positive market outcome. And then to wrap it up, basically the Trump administration's net policy impact we view as therefore short-term negative, long-term positive. We're hopeful for that. But that's just one piece of the puzzle. There's many other things we're looking at. Generally, when we look at the Fed, other central bank policies, we see them as somewhat accommodative. So either keeping rates where they are or lowering rates further. That said, we're still at pretty high bond levels and alternative yields, so we're getting a lot of income and a lot of return from these assets, which is a positive. The fiscal policy, spending, liquidity, despite any DOGE efforts, we still think the US will be in a deficit. And even though long term, that is most likely obviously a negative, in the short term it is stimulative, so that's positive for risk assets. And if you go up to the top, we're neutral for now on geopolitics. We'll just have to wait and see. Inflation, we actually got a couple good prints in this week on tamer inflation, so under 3% inflation, which is good. We'll see what happens with the tariffs, if that's a counterbalance to some degree. But for right now, we put that as a neutral, but hopefully that can move into the positive column. And the valuations coming into 2025, that was really the big negative, was stock valuations. But we're down 10% from the highs now. Valuations are more reasonable than they were coming in. And if stocks do go down further, that would turn that one, that aspect into their neutral or possibly a positive. So overall, we think the first half of this year, choppy, volatile, and it's very possible we could go down further. But if you could look through that to the back half of this year into 26, we think it sets up for a really nice as a reset to valuations. Most of these aspects by then should be positive. So certainly we want to stay invested. And over the long term, 9 months, 12 months and forward, I think we'll be in a good spot. And then last slide is key takeaways. So from this presentation, we started off very expensive on 2025, very concentrated on tech and mega cap tech and the AI trade. That is being washed out. So a lot of speculation and froth is being washed out with this correction. We view that as healthy. It had to happen eventually. That it's happening now, so be it. sets us up better for the future. So we view this as a healthy correction to this point at least. And then the Trump administration policies, negative in the short term, source of volatility and uncertainty, but hopefully that's a reset as well, and that turns into a positive down the road. Hope you found this helpful. Thanks a lot for tuning in. Any questions, let me or your Trap Pagan advisor know. Take care.